G'day, and we're live. This is Zenium Live, where we talk all things money, finance, and property. And I'm your host, Scotty North. And it is Thursday lunchtime. Well, it's kind of lunchtime, right? I mean, we've had daylight saving change, so this is the early edition for Queensland and the late edition of Zenium Live for New South Wales and Victoria because we've had to shuffle our time because we're live, right? So I mean, the time's changed, but we're always there and we're broadcasting globally every Thursday. And that's what I like to remind everybody. So thank you for tuning in live. If you see us anywhere, you can make your comments in the comments box or tag someone. Don't forget to love us and share because that helps everything. And it also makes you look pretty good when you share information as good as this that we're going to hear today. And today's guest, of course, is the none other than PJ Patterson from Keystone Financial. PJ, how you going, mate?
Man, I'm really well. I had to scoff down my lunch really fast, so hopefully I won't have anything repeat on me during the interview. But man, I'm here. I'm feeling freer every day here in New South Wales now that we've had a new premier appointed. Well, I guess appointed, yeah, because he wasn't elected. So I can smell the winds of freedom coming.
Is that so? Well, yes, I do take pity on the New South Wales and Victorians at the moment because in Queensland we're still walking around and you guys aren't allowed to. But that's not the topic of the day. The topic of today is I have been seeing, and because I follow the stock market just so closely, being a property guy, is
Mhm.
so I get to read the decent information from the mainstream media, and there's talk of investors taking flight, or the stock markets are wobbling, or what's going on in the September October US market, etc., etc. So I thought, well, there's no one else other than PJ to get on here to actually answer these real questions. So tell us, what's actually going on in the stock market? Is there wobbles? Has the training wheels fallen off? Or are we just seeing the natural progression? And I'll get you to discuss what we're in, quadrant, as you talk about later on the show as well. So, mate, let me know your thoughts on the stock market.
For sure. Well, you have absolutely come to the right place. For anyone that looks at the mainstream financial media, you are looking at the wrong stuff. Those guys are typically over dramatize everything. And if you see it on the news, it's most likely too late as something that is an investable activity or action. So let's talk about the economy, global economy, first of all. So and we will talk about the quads later. But in the first instance, the US, which is one of the largest economies in the world, in fact, the largest economy in the world, is still going through the recovery and reopening phase. But they are well and truly past the deepest depths of the recessions the recessionary period that we had a little over a year ago. We've had a few fits and starts because of the Delta variant. I think a few people got nervous, and maybe that's the wobbliness that you're referring to. We did have a little bit of a wobble in some of the commodity markets, and particularly in oil, about a month and a half ago, because people were quite nervous about the Delta variant and whether that was going to shut the economy down again. But we're well and truly past that now. We are absolutely powering ahead in terms of the U.S. economy. Europe is on fire. The globe is reopening for trade and for business. And the stock market, insofar as things like technology, commodity complex, natural gas, oil, I'm sure we'll get into some of these things, is absolutely ripping. Inflation, in fact, is probably the story of the day. It was not transitory as the US Fed was hoping that it would be. They've now had to acknowledge that inflation actually it's kind of a thing now. So hashtag inflation. We we do have
Hashtag.
inflation pressures building and continuing to build, and so this is something. And again, we can discuss this in a little bit more detail today. That is going to continue to be pervasive in the market, and it's going to continue to drive asset markets higher.
Yeah, right. Okay, so all right. Well, I mean, there's a couple of points here I always write down, as you know, when I'm listening to you. So let's talk about the inflation. I mean, we always end up talking about inflation, right? I mean, it happens to be. I don't know if anyone else talks about inflation as much as we do, but it's almost like you'd think it was our favorite pastime is to talk about inflation. But the reality is that in the current market, and we're seeing the result of that around us, right? With property prices. I mean, I'm not going to say cars, it's kind of a different sort of pressure, but definitely those asset prices. So what else are we seeing this? If we just see is inflation just the number the Fed's come back and said okay, oh, we were wrong, it is up a little bit? Or what is the actual, result of that number, or what is that in the market?
Well, what's driving inflation right now, broadly speaking, is the US dollar deflating or going down. And of course, supply chain disruptions. It's probably not as simple as to say there's one thing, pardon me, but there's certainly issues that are driving inflation, like supply chain disruptions, like the ability for raw materials to get to manufacturers, shortages, long lead times. And it's translating into manufacturers and other businesses having to increase prices. And when prices begin to increase, of course, that means that wages eventually have to increase. So we get into this cycle of wage growth and then further price increases that are passed on to consumers. And it's kind of a cycle that we go through. But the reality is that inflation is a big function of inflation, I should say, is the US dollar, and it continues to decline. And so we're seeing that show up mainly in things like the price of oil. So I probably commented on this show before that I used to be able to fill up my car for about $1.20 or so, maybe 25 a liter here in my local petrol station. It's now about $1.60, $1.55 to $1.65 in that range to fill up the car. So we've seen that inflation show up right in our face in terms of oil prices, but we're also seeing that across the board in all soft commodities: wheat, soybeans, corn, meat, so hogs and cattle, cocoa, coffee. It's just everywhere. So it's kind of a thing, as I said a minute ago. Hashtag inflation. It's something that the consumer will see because their money, their purchasing power declines rather when inflation rises. So probably not able to fill up the shopping trolley as with as much stuff as you were, say, 6 to 12 months ago. So it is an issue, and the way to protect yourself mainly against inflation is to own assets. So you mentioned property, great asset to own right now. We're seeing a lot of asset price inflation in the property market, and of course you'll probably see that showing up in other places as well eventually. So that's inflation. It's not good, and we certainly want to see it dealt with, but don't know what the levers are they can pull to do that.
So
Well, actually, I do know what the levers are, but they won't want to pull them.
You mentioned that the US dollar is going down in relation to, well, is going down in value, right? But does it go down in value in relation to other currencies,
Oh
or
yeah,
is it
absolutely.
just okay? So with the Australian US dollar relationship, does that mean what's happening with our dollar compared to the US dollar? Or are they both going down in
Yeah.
terms of value to commodities?
It's a good question. So at the moment, and we can maybe drift into the quad discussion, the Australian economy right now is in bad shape. We've just had these rolling lockdowns now for the better part of the last 2 years, and our economy is not doing well. And we're going to continue to see some of the latent effects of that probably for another quarter or two. And so the Australian dollar is not being well bid right now because the market knows that the Australian economy, we're not going to see interest rates rising here. So the RBA will not be able to increase interest rates. And usually that is one of the things that underpins the strength of your currency. So this is one of the reasons why the Aussie dollar in particular has been falling against the US dollar. And hopefully that'll right itself in the course of the next, say, 6 to 12 months. It just, again, depends upon how quickly our economy can get back on track. But it's likely we won't have much improvement for the next at least quarter and possibly 2 quarters in Australia. So that's a bad thing for us. But as you mentioned a moment ago, the dollar, everything is related. So the dollar has a relationship to everything: currencies, commodities, gold, equities, and the like. So if you just think about a currency pair like the US dollar versus the Australian dollars I've just explained, even though the US dollar might be going down relative to everything else, if there's not a compelling reason for our currency to go up against the dollar, it could also continue to go down. And as I just explained, it's a function of our economy right now is not doing too well.
Okay, so normally we got the two currencies, and they can sort of go like that with the value against each other.
Yes.
And I don't have a third hand, so we'll use my face, right, as a commodity, because it's an awesome commodity, as we know, PJ. And so what we're seeing now is both currencies are kind of doing that, right? They're both going down. The commodities are essentially going up. But that's what I'm hearing you say.
Yeah, that's right. Exactly right. So, and not all commodities are rising. So, for example, iron ore. We're a massive iron ore exporter, and the Chinese are not buying as much of it. I think there's concerns, for example, around the reopening of economies, and there seems to be again some latent concern that we may not need as much steel or something. I don't know. So the iron ore price has come back a bit. It'll probably recover in the next 6 to 12 months as economies reopen and we get global trade happening again. And of course, China, which is one of our big trading partners and one of the biggest demanders, I don't even know if that's a word, of
It is
iron
now.
ore.
It is
It is
now.
now. I've just made it a word.
Demanders. All right, there we go.
Write that down. One of the biggest buyers, probably is the better way to put it, of iron ore. Their economy is in terrible shape at the moment as well. So they're actually in quad 3, which is stagflation and low growth. So they're really suffering at the moment. And when China recovers, I suspect that's when you would see both the Australian dollar rise and things like iron ore rise, and our economy will probably do better. South Korea and Japan are also struggling a little bit. And of course, they too are some of the biggest buyers of our commodities from Australia. So it's a little bit of a short-term commodity downside in the base metal commodities. So that's really what we export, things like zinc and copper and lead and, lithium and all this stuff you dig out of the ground to send somewhere to be manufactured or remanufactured or refined rather into stuff we can actually use.
Yeah. Okay. All right. So as we come into to Christmas time, now we're not quite there yet, I know, but I'm doing a little bit of work around the house, and actually, I'm organising a little bit of work around the house, let's just say, and we're already getting the call when we talk to the people. Oh, make sure you get it in the next couple of weeks so we can get it to you before Christmas, right? So there's the wake up call that Christmas is coming because these guys are already starting to shut off and their orders and what have you, but. All that aside, we're in that season, right, of full on the end of the year. We're on the march to the end of the year. So how can people, prepare for that in terms of their investing and also their cash flows, right? I mean, around are we going to use the stock market for some quick hits and some cash flows? We got Christmas coming. Should we be looking to exit some stocks and cash up to buy presents for our children? All this sort of stuff. We're coming into that time of year. What are we looking to do for the next couple of months?
Well, for the next couple of months, in terms of an investing thesis, you want to be on the inflation trade. So you may recall, I think the last time we did an update was probably a good 6 or even maybe 8 weeks ago. And I mentioned oil in the energy complex, and it was not going too badly at that stage. And then we had a sell-off and a volatility spike in the energy complex in August. And that was around, as I mentioned a moment ago, this concern around the Delta variant. Well, we're well and truly past that now. And in fact, the low in not Brent crude, West Texas crude around that time is about $62 a barrel. And oil is now, West Texas crude per barrel is now trading at about $78 a barrel. So the energy complex has well and truly done a runner to the upside. And as I was saying earlier, I think the inflation issue vis-a-vis the dollar going down is going to continue to hang around. So right through Christmas and even into the early part of 2022, you're going to want to be on the inflation trade, as well as probably U.S. equities, European equities, and maybe some of the emerging markets. So emerging markets like Taiwan, Indonesia, Philippines, Malaysia, they do really well when the dollar is declining. So that's another place you could allocate some capital in your portfolio. So energy, if we get some pullbacks, which I'm sure we will. So this would be like an energy ETF. Fuel, FUEL, is a beta shares energy ETF I use. It's quite good. And then just broadly, any sort of commodity type stuff. I would stay away from gold. I know there are a lot of people out there that love gold and think that when inflation rears its head, that gold loves it. Well, gold doesn't, and in fact, necessarily love it. What gold likes is low interest rates. And we didn't get a chance to pivot to that. So this is a great segue to talk about interest rates.
I was going to ask that. Yes.
Yeah. So interest rates are rising. So I just made a little check in my notebook. I track this stuff every single day. I get up at 5 a.m. and do a lot of market data gathering and so forth. And back in August, on August 11th, The Australian 10-year yield was 1.21%. 1.21. And today, or as of yesterday, the Australian 10-year yield is at 1.6%. That's a 33% increase in the 10-year yield in Australia. So the bond market here knows something. And what the bond market, and it's similar in the US, we've seen quite a big ramp in the 10-year and the 2-year rates in the US. What the bond market is signaling, and it's a very, very smart market, one that you should absolutely pay attention to, is that, again, inflation, hashtag inflation, is a thing. And that's why interest rates and longer term interest rates are rising, because of these concerns around inflation. So that will eventually translate, I think, into short-term rates, the 1, 2, 3-year rates here in Australia, and obviously will then eventually also affect housing, which the RBA here, as well as the banks, and I think some other government bodies, have expressed concern about the runaway housing market here in Australia. So one of the best mechanisms they have to deal with that is interest rates. The RBA doesn't look likely to raise them because the economy's stuffed. And so, in case you weren't aware, the APRA came out yesterday and has instructed the banks to raise their servicing, the rate they use in servicing calculators. They've raised the floor rate. So this is one of the levers they can pull to try to get credit, or try to restrict the flow of credit, to make it a little tougher.
But that's only because that was only dropped, what, 18 months ago or something? They dropped that from a long-term average, didn't they?
They did drop it, yes. It was probably a little bit more than 18 months, but yeah, you wouldn't be too far off. Probably in the last 2 to 3 years, they certainly have made adjustments to the downside. The servicing rate used to be around, 6.5%. I think it was dropped to 4 to 5, and then they allowed banks to sort of let it float a little bit as well. So you can see some rates around that 3 to 3.5%. So they brought the floor up to, I think it can't be less than 3.5% now.
Yeah. Okay. And that floor, are you talking the baseline floor? We're probably getting a bit technical.
This is for servicing calculators. This is for servicing calculators. Yeah, it's not obviously the rate that you pay. It's the rate that they input into the calculator as an expectation of a potential higher future rate, to make sure that you're able to service your mortgage. So
is that 3.5%? Is that above the rate you're actually getting?
No, I believe that's the floor rate. So that's the actual floor rate. Yeah, okay. I know it's quite low. I'll double check that, because I only briefly read an article on it, right. And it would be.
Well, I was going to talk to you about the RBA and interest rates, because they have seemed to have had a bit of their own marketing campaign for the past 4 weeks, and every second article I read about them is all about how the housing crisis isn't our fault. No, there's not much we can do. It was government policy. Seriously, I've got a list of articles in the store about all this sort of stuff, and I liken it to, if the Australian housing market is one of our bushfires, right? then the RBA is the interest rate setting, is all the fuel on the floor of the forest, and the government policy is the spark that starts it. But the fuel was driven by the low interest rates. To the RBA to come out and say that, it's not us, it's them. It's like, look over there, don't look at me. It just sounds like they're just being a bunch of wallies.
Well, look, it's this never-ending thing. Ever since I moved to Australia 23 or 4 years ago now, the housing market has been the thing in Australia that powers ahead our economy. It creates a tremendous amount of wealth for Australians, and it's sort of one of those things like, Centrelink benefits, the age pension. You just don't touch it. You don't legislate around it, because people get angry and they tend to vote governments out of office on big policy decisions. But the issues around housing affordability and just availability of housing for the next generation seems to be the topic du jour at the moment, where they're saying, well, my kids will never be able to buy a house. It's just too expensive, or I have to save for 20 years before I can buy a house, and then forget it. In 20 years, it'll be triple the value, so I won't be able to buy anyway. So there's all of these debates that they always come up, especially around the time when we have a, quote unquote housing bubble, or we have a big run in housing prices. They always come up. Now, I think the market will resolve itself. If you just leave markets alone, they typically tend to resolve. And so, the counsel to a property buyer right now would be to say, well, don't get caught up in the FOMO and the frenzy of it all. Maybe just sit on your hands, save some more money, sit on your hands for maybe 6 or 12 months, wait and see if interest rates begin to rise, because all these little things that APRA might do or the RBA might do to chip away at the overall, we could debate whether it's in a bubble or not, but let's just say it is, right, for the moment, to chip away and deflate that bubble a little bit will benefit a potential home buyer in, say, 6 or 12 months, because prices will begin to regulate. They might even come down a little bit. The heat will come out of the market. So, that's the way I see that whole thing.
Yeah, that's right. And the problem is, though, mate, is that the only people whinging about house prices going up are people who don't have houses, and it's a smaller proportion of people like who actually want to buy houses than actually own them now. And of course, as soon as those people buy a house, well, they become a homeowner, and then they want the house price to go up. So
Of
it's
course.
like
Yeah.
it's this never-ending cycle of like, oh, I can't afford it, but I got to get in. Then it jumps. Oh, now I want to go up, and oh, no. So it
Yeah.
just goes round and round, and it is pretty crazy in some of the areas out there at the moment. So
It is.
okay, so APRA's doing that. So they are trying to use some of the very limited tools they've got to adjust those rates. But you talked about the bond market.
Mm.
We've had a 33% increase in that long-term interest rate average. Is that what we're saying? That 1.21 to 1.6?
Yeah, it's not an average. It's just the 10-year Aussie bond. And
10-year
it
bond?
obviously
Okay.
fluctuates, in a range. But I'm just saying since August 11th, it's gone up 33%. The rate
All right.
has risen,
So
which is a big
does that
move.
indicate a rise of interest rates across the board in elsewhere, or what does that actually signify?
Well, okay, so it doesn't indicate that rates are necessarily going to rise in the short end of the curve. So the Australian market, um, at the moment, the RBA is managing the short end of the yield curve, so 1, 2, and 3 year rates. And so you're going to continue to see reasonably cheap money, I think, still floating around. You'll be able to get a 2 or 3 year fixed rate for, probably very low 2% range. Maybe there's a few out there for 189, 199, this sort of thing. And that's just a function of the fact that the RBA is suppressing the short end of the curve. What the long end of the curve is telling you, so the 10-year, they don't mess around with that rate as much as the 1, 2, and 3 year rates. What the 10-year rate is saying to you is, I see inflation. It's coming, and we have to readjust the longer term rate, because to attract capital, for the Australian government to attract capital, which is effectively what they do, they sell bonds into the market, and there's a rate on that bond, and they use the money that they raise from the bond sales to fund our budget, and in most cases a budget deficit at the moment. And so to attract capital, because the market knows that inflation is around, it has to offer a better, or a higher rather, interest rate. So that's what we've seen, is this adjustment going on where the bond market is saying, yeah, we see inflation. For you to get my money, you're going to have to increase the interest rate. And so we've seen it now show up there. Eventually it'll make its way to the short end of the curve.
Okay, well, we got about 5 minutes left. I wanted to ask you about Sydney and Melbourne opening up, and we often talk about how financial markets pre-price in certain activities. Now, it's fairly known that these places are going to open up by the end of the year or the next month or whatever. International travel's looking to start again, all that sort of stuff. My question to you is, have we seen the stock markets in Australia price in that potential, hive of activity that's about to happen, or is it yet to be priced in and see the result? That's the first part of the question. The second part of the question is, how does that affect what sort of quadrant we're in terms of the investing mindset moving forward?
Okay, so I'll deal with both questions in this way. We'll reverse them. So we're in quad 2 in the US, which is reopening. That's a growth quad. That's where inflation is up, interest rates are up, and generally the stock market loves that environment. So you want to own things like small caps, you want to own commodities and industrials, technology companies, that sort of thing. So broadly speaking, in the US and Europe, quad 2, that's great, thumbs up. So you'd probably want to have a larger allocation of your portfolio to international equities because of that. The Australian market, however, because we're in quad 4, that's going to be detrimental locally to our company. So earnings are going to be a bit flattish. You won't find too many places to hide in Australia. You'll probably be more defensive. If you're an Australian-only equity investor, you would probably right now be on a slightly more defensive tilt because the Australian economy is not doing great. And that should reflect in the stock market. It already had a bit of a run off the back of what was going on in the US. And then the two economies diverged. So we went into quad four, the US went into quad two. We'll eventually come out of this. And I think, again, as I said at the outset of our broadcast today, is that once China and South Korea get out of quad three or quad four, China's in quad three, that will probably pull Australia out of quad four as well, because they will fire up all their industrial stuff again, their manufacturing, and they'll be demanding more raw materials, which they'll, I hope anyway. We do have some geopolitical stuff going on between Australia and China at the moment over a submarine deal. But anyway, hopefully we'll see that pull the Australian economy out. The other thing that we probably have going for us is with all of this reopening, with the big, large economies being Sydney and Melbourne, local economies, that is, consumers will still have a lot of pent-up demand. So I think you alluded to Christmas a moment ago. Christmas this year, if, touch wood, we stay open for, through Christmas, we should see a nice boom in consumer spending. So some of the stocks you could potentially look to pick off would be like your Harvey Normans, your JB Hi-Fis, some of the consumer discretionary stuff. And I'm not saying to go out and buy these, do your own research, obviously, but that would be a place to potentially look for opportunities for upside in the Australian economy. And of course, then just be defensive as well, and maybe just try to earn some dividends while you wait.
Yep. Okay. Well, that's good. What a great wrap up there. Thanks for that, PJ. And I'm going to take them as your closing comments, because I know that we've hit our time limit and we need to bail. So thank you for joining us, and thanks for all the insight and telling us about the quads, the inflation, which we always end up talking about, the bonds, rate, that sort of stuff. So, mate, thanks again for joining us, and we'll see you next month, eh?
See you then.
All right. Well, that was PJ Patterson from Keystone Financial, bringing us all the good goss on what's going on in the current stock markets in Australia, the US, and the world, because we broadcast globally. That's right. Xenium Live every Thursday lunchtime. That's still lunchtime Queensland and New South Wales Victoria time, so we sort of managed to squeeze it in there at a good spot. All right, if you've got any questions or comments, feel free to hit us up on the details scrolling at the bottom of the screen. You can write to us at hello@xenium.live, and you can say what a great job we're doing, here's a topic that we want you to sort of dig into and discuss, all that sort of stuff. And also, don't forget to like and love and share our posts wherever you see them. Jump in with the comments. Thank you, Shane, for watching today, Paul, and a few others that have been on there. We really appreciate that and showing us all your love. All right. Thank you also to the podcast, Xenium Live podcast, which you can get on all the good podcast apps. So thank you to all the listeners there. We appreciate you listening to that and kicking those numbers along. That's it from me. I am Scotty North, and today we've been talking to PJ Patterson from Keystone Financial about all things money, finance, and property on Xenium Live.